Hello, everyone, and welcome into CrushTheStreet.com. I'm Kenneth Amaduri, and I'm joined today with a returning guest, contributing editor here at CrushTheStreet.com. Her name is Trader Steph, and she puts out tremendous articles here on a regular basis at Crush the Street. Technical analysis, talks about the economy, and great updates on what's going on and current events as they relate to the geopolitical and financial scene. Trader Steph, thanks for coming on the show with me today and being a returning guest.
Hey, Ken. Thanks for having me back. It's been a while. Looking forward to it.
Well, why don't you update everyone on how everything's going? I know you've been in the housing market as of recently.
Oh, yeah, unfortunately. Yeah, I'm up in New Hampshire. I'm going to live free or die. That's the way it's going to be. But seriously, I was living down in Maryland, actually, when I hooked up with you, with Crush the Street. And at that time, I was dealing with my parents. They're kind of up in age and had to sell their homes, get them moved into a retirement community. And my goal was to get to New Hampshire once I knew they were settled safe. So that took about 3.5 years. It was pretty challenging. And when I packed up the truck, when I was leaving, I had to put my car on I didn't get the trailer, I got the little dolly thing, and on the back of the U-Haul truck. And as it turned out, that day that I was scheduled to leave, which I had to leave, I had no choice. I couldn't reschedule because of things I had lined up at the other end when I arrived for unloading. It was like that really bad northeaster storm we had that weekend. And oh my God, it was raining, it was pouring, you couldn't see 5 feet in front of you. I got a 12-foot truck that was packed with a 5,000-pound car on the back, and I had no experience dealing with that whatsoever. But, a 9-hour ride turned into 17 hours.
Wow.
And, then going through the mountains, through Vermont, up and down the hills, and the wind's blowing, and it's raining. I thought I was going to die. I have my hands on the steering wheel, But I got up there into a temporary situation up in the North Country, as they call it up here, north of the White Mountains. And I had about 3 months to find a place to buy. And, everyone's got in their mind what they're looking for and what they want. But when you get into this particular market, you got a specific budget and you got a specific time frame. It was quite a challenge.
Okay, so tell us about that. I know you'd written about lack of housing inventory and, the unaffordability dilemma in the new normal. What's the current market like up there?
Yeah, well, you keep in mind, say you live somewhere and you're looking to buy in the region that you currently live in. So you're familiar with, the weather, geography, the market in general. Hopefully you've been researching it if you're looking to buy. But when you go to a new state where you've never been for it, you got to get familiar with the state, the market, the geography. And like New Hampshire is very different because you got the White Mountains stuck right in the middle. And that's basically all tourist and ski resorts. And New Hampshire is only about 190 miles from north to south, and it's about 70 miles wide. And the big populations are spread out where the majority are down in the south, and they're very small communities up in the north. So if you're looking for something, it generally takes a long ride to get there, particularly if you're up north, because then you take into account what you just mentioned, the June 28th article I put out about the lack of housing inventory and the unaffordability dilemma. I had thrown myself right into the middle of that, which is why I began writing about it. And then you got Sam Zell out there. He's like, well, now's not a time to be a real estate seller or a buyer. And I'm like, oh my God, I can't believe I'm actually having to do what I'm probably suggesting that you don't do. But life is like that. You got to do what you got to do. So the inventory was very low, and it's not because there was lack of housing available. It was because of the market dynamics that were going on. So, and up here, it's a very different market because a lot of properties are seasonals. So you got folks coming from Massachusetts, Connecticut, maybe Vermont, New York, or some other state, and they only come up here and they stay in the summer or they stay in the winter, but depending on what it is, you have a different type of mechanical setup in the house. Like about 80% of the homes in New Hampshire are based on drilled wells or dug wells. So if you're going to be living there in the winter, it needs to be winterized. So when you're looking at properties, you got so many things you need to take into consideration, as well as the weather patterns up here, because there's harsh winters and they're subject to flooding depending on where you're looking. So getting to the realtors, talk about live free or die. It's a different mindset, as they call it up here. We're just a bunch of Yankees, is what I was hearing. But I found someone who was really good, and she was pretty helpful, but I ended up finding the place myself rather than her actually taking me to it. Matter of fact, she didn't even visit the property that I ended up purchasing.
Oh, wow. Okay.
Yeah. Very hands-off type. Well, with technology, you got everything. You can see pictures online. You do all the contracts online. It's just very different kind of world. Plus, you've got the culture shock up here. So the different properties I was running into, it ran into everything from looking at houses with their own land where there weren't proper disclosures. Like one house, it turned out the guy that lived there committed suicide. Blew his head off twice, 2 bullets, because the first bullet didn't work. And I was going to put a contract on that house. And thank God I went around talking to the neighbors, because I'm like, look, I can live in a house where maybe something bad happened, but when it comes to something like that, to actually have that thought in front of you every day, it just wasn't going to happen. So that was really disappointing. And I was looking at manufactured homes too, but the communities and the homes that I was seeing really weren't working for me. So what ends up happening is there was a seasonal way down south that I really wanted, and I had put 2 offers on it. Both offers were rejected, and as it turned out, there were disclosure problems on that property too with regards to the well. So it's real important, no matter where you're moving, that you're familiar with the real estate market, the geography, the type of housing. Just don't buy anything because you want to buy something and it's pretty. So I end up buying a manufactured home in a manufactured home park. And there's perception and then there's reality. And with this particular place, it came on the market. I got an offer on it. There was another offer on it that same day. It was only on the market for 2 days. And I thought, wow, the market's was kind of like that. When you found the right place and low inventory, the bids would come in quick. And there weren't necessarily bidding wars. Up here, they would just take the highest bid. And then they would not give the next bidder a chance to up your bid. So those folks, that contract fell through, and it came back to me on my birthday. So I put an offer in for the asking price, and I made it through the process. Now, there's kind of like a shift going on out there because of what's going on in the market, where there's a lot of cities that are buying up manufactured home parks because of the affordability issue. And people have this perception about mobile home parks. And, there are some that are like that perception that people have, and then there are those that are not even remotely close to what that looks like. A lot of mobile manufactured home parks are being taken over, and they become cooperatives. Just like when I lived in New York, you had apartment co-op buildings. Everyone actually owns the building, except in a mobile park, you own the home, but you don't own the property, and you pay a small fee every month, and they take care of everything. So it's really nice, and it'll work. I'll get some more acres in New Hampshire coming up in the future. But there's definitely an issue when you look at the Case-Shiller chart. I mean, prices are beyond what they were in the bubble in 2007, 2008. And when you look at the income that's necessary in order to meet mortgage obligations, and wages haven't picked up, it's a nightmare out there, quite frankly. And I don't think most folks are aware of that. So if you're able to find what you're looking for and it goes smoothly, great. If not, you're going to have to get what you need rather than you want.
You know what, Steph? That actually is an interesting point, because it also goes to show in a deflationary environment that people are going to need to still live. And that goes to show why sound money, because it's deflationary, still works, but because of the Fed and the nature of the government needing to stimulate, they can't. They have to scare people into buying now because of the fear of higher prices tomorrow. But you brought up a good point, and that is people are going to need to live. And sometimes you just need to do something because it's the best thing to do right now. If you need to go to work tomorrow, you need to fill up your gas tank today, despite what gas prices will be tomorrow. And you need to live somewhere today, despite what prices are going to be tomorrow. And it's one of those situations where you just need to make the best decision possible for your future, and I think you did that. But having said that, what are some of the valuations looking like in the real estate market, and is there any indication as to what you're expecting here going forward in 2018, 2019?
That's a good question. One thing that can happen is interest rates go up. That'll blow it out of the water. We're right on the edge right now, with rates having gone up, 75 basis points, basically.
So what do you have to say about the lack of inventory? Can that go away, or can buyers dry up overnight and the inventory flood onto the market? Or because every realtor I talk to is like, it's tight out there. There's not enough houses for all the buyers that want to buy.
Yeah, well, it's more so tight in the mid-range and lower range because of the affordability issue. But it's also got more to do with folks who are still underwater from the previous. And then you look at the employment market out there. It's not like it was 10 years ago before the bubble bursted, where people were able to move and relocate and find other jobs and sell their house that they bought and pay off the mortgage and make a profit and pick up something else. No, it's a whole different ballgame now. So people are generally, I think they called it nesting, but that's not what this is. You also have the baby boomer bubble where, I shouldn't call it a bubble, but you got the baby boomers who are basically retiring and they're staying put, but that's not necessarily true either, because a lot are selling their properties and moving into retirement communities. But that's a very individual choice and decision based on economics, because those places can be more expensive than just staying put. Do you have the means and the support system around you to stay home is the question. So there are a lot of variables here and a lot of different real estate markets. And like when you look at the commercial real estate market, that's a problem. That has a lot of inventory. It's the complete opposite. And that's because of a lot of debt. It's not because of the internet taking away their sales. I think right now we're looking at about 9% is what online sales are. That's not what's killing brick and mortar. What's killing brick and mortar is the lack of cash to spend.
Mm. So, Steph, in terms of prices then, would you say that they look like maybe some of these FANG stocks, which continue to go higher and higher based on, I don't even know, just general marketing? Amazon continues to go higher with a handful of profitable quarters, and it's almost never looked cheap in its entire history, but yet, who knows? Maybe Amazon goes to $2,000.
Well, let's keep in mind, we've got the new Fed chair, right? And the reason that the market's going up is not because of fundamentals, but because of all the quantitative easing that had went on since the financial crisis. So when Trump had to decide, he had his wish granted. I did an article on that on the 29th of October. Turns out he did. He got his wish granted, and he picked Powell, and Powell's a dove. And if it boils down to, it seems like every time it's at some point a year, there's something going on, and you're looking for a reason that so-and-so is going to happen. But that's just the way the flow goes. So we got the next Fed meeting in December, which I think it's like 100% chance as far as the bookies are concerned that there's going to be an interest rate rise. And then you have the tax reform bill, because nothing officially has been passed in Congress, despite the fact that he's done a lot and a lot has been accomplished, but the mainstream's not talking about that. So we got interest rate decision, and the new Fed pal's not going to be in the chair position yet, but that is going to affect the outcome, not just the data. And then we have, well, what's going to happen with tax reform? I think that's really going to direct the market, no matter what industry within the market that you're talking about, whether it be FANG or whether it be real estate. That's going to be your answer.
Yes.
In the near term.
Okay, Steph, so let's continue. I'm curious to get your thoughts on the current Fed chair and just kind of what's going on with the situation at the Fed, because if in so many situations we can look back and see the rising, expanding balance sheet of the Fed and the uber 1% in getting rich and the middle class getting crushed and the stock market's rising, real estate rising, all based on what the Fed is doing. So any thoughts on this?
Yeah, I came across a presentation that Lynette Zhang, I think you've had her on.
Yes.
Did, and one of her slides she's got, it's about mortgage-backed securities held by the Fed. And remember, the Fed's supposed to be winding down their balance sheet, which I don't think's really going to happen. They may attempt it on some level, but it's the great paper caper. But this chart she's got of the mortgage-backed securities that are held, suddenly there's been a lot of buying. Like, this chart is correct. This is coming from Fred, St. Louis. There's been an 80% increase since the summer. And also in October and November, not 80% in each month, but I think the chart's up on the screen. You can see the spike. So there's still a lot of heavy buying. Now, is this the last Hail Mary pass before? Not really sure, because these aren't bonds. And the bonds are really what they were talking about on the taper caper. In the meantime, they're still purchasing the mortgage-backed securities in the background. Let's see how long that lasts. But as far as the Fed, remember, there's still a lot of seats open where folks are leaving, stepping down, retiring for whatever reasons that they have, and those seats need to be filled too. So the Fed is going to be completely redone by Trump. And I guess I should have mentioned, so will the Supreme Court.
Steph, so let's talk about Saudi Arabia and the implications that this is having on the market, precious metals, and I've been so focused on, precious metals and cryptocurrencies. I haven't even followed it very much. So I'd love to get a full update from you. Let's get your thoughts here.
God, there's so much information. There's so many changes and shifts and subtleties geopolitically with Saudi Arabia. It's impossible for me to actually cover it all. So I think I'm just going to kind of look at the forest instead of trees. And first of all, one of the more popular images that came across the media airwaves was when Trump went over to visit Saudi Arabia, and he was out there when he immediately arrived and got out of the car, and they were walking between the car and where they were going to have the dinner. And he's dancing with a sword. Oh, the media had a heyday with that. So the question is, who held the sword first? Was it the president of China? Xi Jinping? God, I can't pronounce his name. I'm sorry. So I'll just say the president of China. Or was it Trump? It was the president of China, because he was there in January of 2016 to discuss the Silk Road project, which is a huge deal. And the Silk Road is going to be passing through the Suez Canal. Big deal. Trump didn't come in until May of 2017. Matter of fact, I'm not sure the exact day that the Chinese president was in Saudi Arabia. I don't know if it was before the swearing-in ceremony of Trump or was it after? But, it wasn't January. So China's got the jump on this because they have their own plans. Trump went to talk about a lot of things, I'm sure, that has not been put out in the media and never will because he's very tight-lipped, loose lips sink ships. But he was there talking about terrorism. And obviously, with some of the news that is coming out recently, I think Saudi Arabia is very happy from this shift from the Obama administration over to the views that the Trump administration has, because they felt really dissed about Syria. And the other thing is that the oil, I'm not going to say they're running out of oil, but they've got a lot less reserves than what they're leading into. And there's been a lot of technology thrown into those old wells, very important. Those are very old wells, to pump out every drop that they can. Plus, they've been upping the production of late. And that was really about trying to kill the shale business that was cutting into their share of global oil trade. Well, that kind of backfired on them. So they've realized that they need to financialize the economy. They can't be an oil economy as they used to be with basically a welfare state, because they're all living off the oil. Because now you have a much younger generation that needs to be integrated into the world market. So now we have them wanting to make Aramco a public traded company to be worth trillions at the beginning. And really nobody can make a profit if oil is below $50 a barrel. And there's a really nice chart there that lays out, each country about where they need to be in order, what price per barrel do they need in order to balance their budgets.
Steph, if you would, let me jump in right there. If you would, remind everyone what the significance of the Silk Road is, for the U.S. and China, please.
Well, I would compare it to, imagine if there was no Panama Canal, how different world trade would be. You'd have to be going around the Arctic Circle or going all the way around the southern tip of South America. So with that in mind, visualize that. China is going to be connecting the old trade route that will extend, which has already started. The trains are already rolling into Northern Europe. And then there's going to be a maritime route that will be going through the Mediterranean, the Suez Canal, up southern India. So there's this big circle where there's going to be the new Silk Road, or they're calling the Belt. And that's going to internationalize the Euro-Asian Middle East trade bloc. So I think that's kind of like where the Petro Yuan may be coming in to play. And then you've got the gold-backed contracts. And that's another whole story that I really don't want to get into in this interview, because that's an interview in itself. Now keep in mind, Saudi Arabia has decided they're going to build this new metropolis, the new king. The new king is the one that's trying to implement all these changes. They want to call it NEOM, N-E-O-M, and it's going to be a free trade zone right off of the Suez Canal. That's got to do with China. So then we've got Iran. We've got a military issue here. That's what the business about Trump was there. Now, while all these things are going on, they're locking up all these folks and they're taking their money, and Trump sends out a tweet. He says, they know exactly what they're doing. Don't worry about it. There's a much bigger game going on here that no one is really picking up yet. And I'm sure there's folks out there that may have talked about it and mentioned it, but I'm certainly not aware of it. I don't see that big of a picture quite yet. I think it's going to be one of those black swan events in the markets. So he's got great confidence in whatever Saudi Arabia is doing right now. But at the same time, we're concerned about all these proxy wars, because Yemen and the potential for Lebanon and something with Iran is all about Iran and terrorism. And Hezbollah and Lebanon, this is just brewing over there. Whether it's some kind of diversion, I doubt it. This is a shift in policy. And then North Korea? I mean, let's throw that into the equation. How did that play into this?
Steph, let's switch over now to North Korea, the implications that's going on in North Korea. I know for me, the risk of an EMP and something going on in here in the U.S. I mean, that's the game changer, right? That's the ultimate end game. You know, despite gold going up, despite anything going on in the financial markets, I mean, this is, you know, what's going on with the war scenario in North Korea, and just your general thoughts on it.
Well, today there was a news report came out. Remember, Trump went to China when he did his Asian trip over the past 2 weeks. And immediately after he left, China sent an envoy, a group of folks, down to North Korea to have a chat with Rocket Man. Unbelievable, the names he comes up with. Well, it turns out, as far as we know right now, it looks like the envoy may have not even met personally with Rocket Man, which is a big shift. That doesn't happen. So it may be showing that there's some break in the trust between North Korea and China. And now Trump is counting on China to diffuse this. I'd have to agree with him for various reasons. You'd have to go into the history of China and North Korea to figure that out. But I did an article on the 23rd of October. I called it The Punishers. You know, the U.S. preparing to put nuke bombers on 24-hour alert. And, you know, there was a lot of talk about, they're not going to do that. And this is, if you actually think that the United States doesn't have contingency plans in effect that are 24/7 based on nuclear awareness, you're dreaming. Get your head out of the sand. They've always been on 24-hour alert. And what capacity? You know, who knows? But it's a scary situation. And then you talk about EMPs. Look, you know, they got a satellite floating around up there, North Korea does. And I think we know exactly what's in it. There's a lot of conjecture about what that thing is actually doing. It could just be a communication satellite. We know exactly what's in there and what it's capable of. But like you say, EMP, if you're going to be looking to retain your capital and retain your wealth, you want it in your hands because you don't want to have counterparty risk. And North Korea is a glaring example of what counterparty risk is on the geopolitical landscape. And then when you drill down into the details, well, you know, if there's some kind of EMP or there's a small-scale terrorist attack and something goes down with our systems, you know, it's going to be complete chaos. So there are preps being made to try to address that, but we are so way behind the curve versus countries like Russia, it ain't funny. So you need to create your own central bank and your own bunker.
Steph, let's move on into the implications on the markets. U.S. dollar, I want to get into gold here. Let's move on into these topics here. I know you got some interesting analysis.
Yeah, I got a U.S. dollar weekly chart there. And it goes back to 2014. And let me just pull the details out of this chart. So we got all the moving averages. I got them all marked for everyone to see very clearly. We got your Fibonacci levels. Those dotted lines that are horizontal going from the 100% on the bottom up to the high end of the dollar that was hit in very late 2016 at 103.82, which wasn't the all-time high, but that was the near-term high. And we had this big megaphone broadening top pattern, which can be bearish or it can be bullish. It depends on what it does and when. Like we had a megaphone in gold, and I'll point that out in the chart. I didn't mark it on my gold chart, but it broke to the upside. It could still go to the upside, or it could go to the downside. It really depends on what this current leg and this little upside that we had, what it does. Now, when you look at that megaphone and you see that price began to fall, and it went through all the moving averages, and that's a descending broadening wedge. Now, that can be potentially bullish, which means we may bounce back up and hit that top line of the megaphone. We don't know yet. But in the short term, since about September, we pivoted off a Fibonacci level. We violated the 200 exponential moving average. We bounced off the 50% Fibonacci retrace, which goes to the 2014 low up to the late 2016 high, about 50%. We bounced, we came up, we hit the next fib level up, the 38.2 at just above 94.30, and there we've got a rising wedge, which are always bearish. I've just never seen one break to the upside. And last week we broke back down to the downside. So my target is the bottom of that broadening top, or a retest of that 50% Fibonacci level. So it's still bearish. And when you go down to the bottom of the chart, you got the DMI, the ADX. Whenever these cross, the ADX is the black line, kind of like a tongue, and the DMI is the red and the green line. So if the green line is up top and the red line's in the bottom and the black line is coming up through it, you got a tongue, that's bullish. When they're reversed, that's bearish. So you can see very clearly on the chart how that plays out. Right now, we're still in a negative pattern for the DMI ADX. And the Stochh RSI, the last indicator at the bottom, it's rolled over. So right now, we're in bearish mode. And as we talked about earlier in the interview, we've got two things coming up. We've got the tax reform, and we have whether or not we're going to raise interest rates in December. That's going to have a big effect on this, not to mention geopolitical concerns.
Steph, let's talk then about, the macro situation going on with gold. I know it's been pretty, discouraging seeing what's happening with gold just being lackluster and not moving that much. But we had some pretty exciting news here coming out from Ray Dalio and him doubling down on his position with gold. He didn't have gold in his portfolio prior to 2017. He dipped his toes in the water earlier this year, and then he dived in even further later on in the year. So let's talk about that a little more.
Yeah, I think for some, looking at the charts can be discouraging, but if you've been in the market and have followed the gold market since the late 90s, it's extremely positive, actually. So looking at some of the most recent, headlines, we got Ray Dalio, obviously, from Bridgewater. He's upped his holding of GLD 575%. He's buying paper. I mean, who knows what he's actually doing on the side for himself, but there's no doubt in my mind that he's buying his own physical. But remember, this is a hedge fund. This is what they do. They're hedging. So he's hedging for something. What's he hedging for? We could probably come up with a list of a dozen reasons why. And we also have the demand. The fundamentals are still very strong, despite what you may be hearing. I mean, gold is hitting at or above or near all-time highs in almost all the other currencies as compared to the U.S. dollar. It's just, in U.S. dollars, it looks a little sluggish, I should say. It's more stealthy than anything, in my opinion. Turkey had another really big quarter in their gold and bar and coin demand. It's 3 times of what they were doing in 2016. And I think the big news on the demand side is not necessarily China, which it usually was, because their demand and what's coming into the country is really hard to determine right now, because it's not Hong Kong anymore. It's coming through back channels and through Beijing, and it's not there's not one easy way to look at some chart or some piece of information. But Koos Janssen is a really good source for that. But Germany is now the world's largest buyers. We're not just talking central bank. They pulled all their gold back from Paris and the United States, which was supposed to have taken a lot longer, but they actually got it done a lot sooner. Per person, they've got the highest demand in the world. It's double China's, double the United Kingdom, and double the U.S. demand. So remember, Germany had their issue with hyperinflation back in the 20s. Not that there's a lot of folks still alive right now as there were back in the 20s, but they understand money, I think, more so than most Western populations. And so there's a lot going on in the world. Plus, you got the influx of all the refugees, and there's a lot of issues with their politics right now. I think today Merkel Her coalition that she was trying to put together fell apart. So there's a lot of news items flying around today about that. But as far as the gold charts, there's these things I call buckets. And they come and they go. There's a lot of small ones, but within the past month, I've seen this other bucket pattern reappear. And when they start appearing like this, I got two of them. I got one from November 6th and one from November 14th. You know there's a shift in direction coming. Now, given everything that we've looked at so far, when I get this monthly chart up and the weekly, we'll drill down into the details, but my guess is it's going to be the upside because we've already went through some short-term downsides, which actually isn't because we're putting in higher lows. But these buckets, it used to be when we would have these mini pukes, as they call them, it'd be good for $50. They dump millions, billions in notional dollars in paper contracts to whack the price at specific times across the globe to get the price down. It used to fall $50, $60. Now we're getting 10, 20, and then it gets bumped right back. So that's an interesting pattern that we have seen for some time, but these buckets now are becoming more pronounced as far as I can see. And these two, the November 6th and the November 14th, are 15-minute charts. And the bucket's very clear. You can see how on the downside, the volume's actually falling on the downside. And then when it's being bought, the volumes are increasing. Anybody who works in technical analysis or trades in the market or does investing understands what that means. If the selling is going on lower volume, it's not a very strong fall. But if the price is falling and the volume is going up, you can expect more downside. And then the opposite is true when you're coming into the other side of the bucket. So there's two buckets. And let's take a look at that monthly chart. You got that with you, Ken?
Sure do. I'm going to put it up on the screen right now.
So this monthly chart, I got this going back to 2008 during the financial crisis. You know, it's always good to look at the big picture. And there's some patterns that I'm more focused on than a lot of other patterns that folks are talking about near term. And it's these inverse head and shoulders. And they can come several different ways. If you look at the one between 2008 and 2010, you see how you got that neckline, that horizontal line on the top, and then you've got, it's like, you know, your shoulders and your head, but it's upside down. That's generally bullish. Once you break out the neckline, maybe come back and retest it in the near term and then bounce off of it, and then you get a nice takeoff. Start looking more to where we hit the high in 2011, and you notice that we've got this inverse head and shoulders that is long term. Remember, this is the monthly chart, which is spreads all the way out to around late summer 2017. We've got a giant inverse head and shoulders here on an angle. And that's that 2011 trend line that's going down. And on that trend line, you notice that it breaks into two. So I got a trend line 1 and a trend line 2. One of those is actually a neckline to another little inverse head and shoulders, which we'll see when we look at the weekly chart. Now, there's this big neckline there, the 1380 neckline. We haven't gotten up to that 1380 and tested it again, but that's an inverse head and shoulders. So the trifecta I'm talking about is from the 2011 high down to the present. And then we've got this other one that's playing out with the 1380 neckline. The smaller one off to the right, I'll show you in a weekly, we've already confirmed and broken out of. So there's only one left. We've taken out the trend line from 2011. 1380, which is also a Fibonacci line. And you can see if you drew your Fibonacci's from the high in 2011 down to the low in 2015, that's a 38.2. Now there's one more number I got on this chart. It's 1520. That 1520 is the triple bottom that we tapped through 2011, early 2012. If we can get through that 1380 neckline, that's going to be the first pit stop. There'll be, you know, on a near-term chart, there's going to be some resistance along the way. But 1520 is what I'm looking at if we take out that 1380. And if you look down the chart, Notice the volumes are really strong. There's nothing small about these volumes coming off of the 2015 low at all. The DMI, the ADX is still positive. The Stochc RSI is still positive. There's nothing negative about this chart at all. So when someone's saying gold's not doing well, it's doing fabulous, actually. It's building up a base, and it's putting in higher lows. And when we take out that 1380, we're going to confirm higher highs once again. So if we move on to the weekly, this is kind of like where it all begins to make sense. I know it looks a little busy, but you just kind of look at the whole picture for a minute. You got all the moving averages. The most important point about this chart is one item, and that's the 50 and the 200 exponential moving averages. They have not, the last time they crossed was at the beginning of the bull market in gold back between 1999 and 2011. That's the last time they crossed over. Now, after the fallback in 2013, they crossed negative, but they crossed over, I would have to say, I've been talking about it for a few months because I've been watching it, but it was around August, September. They kind of came together, but you weren't sure which way they were going to go. And now you've had this choppiness going on, and that 50 continues to go higher. So we've actually got a 50-200 cross. It's not decisive yet, but remember, this is a weekly chart. So let's look at some of the bigger pattern here. You've got those two trend lines, the 2011 trend line, the number 1 and the number 2. One of those is an inverse head and shoulders, and you can see the angle where I did the shoulder, the head and the shoulder with the little dotted lines. So you see how we broke out of that, we came back down, we retested it, and where we retested it was where the 15 to 200 crossed over, right where that arrow is pointing to. Now we've bounced back off of it. And there's another little trend line that we just went through on last week's candle. So and another important point about this chart are the volumes, because if you go all the way down to the bottom, you'll notice is that when we have these important moves, the big moves, the volumes are rising on these moves. But in the near term and much shorter time frame charts, there are times when the price is going down and the volume is rising, yes. But in the big picture, the volumes are falling on the price falls, and the volumes are rising on the price moves up. So we've got this nice pattern of lower highs. The DMI ADX is still positive here. Now the Stochc RSI fell through when we had this most recent correction from about September up until October. But we're getting ready to cross back up through that. So I'm bullish right now near term. And I think folks will say, well, you're always bullish. No, not necessarily. If you follow my Twitter feed with my gold charts, and even there's Bitcoin charts, I kind of try to give folks a heads up on where we are in the near-term charts and which way we may be moving and what to expect if we go this way or if we go the other direction.
You know, Steph, a lot of people are wondering if we're going to see a Bitcoin-type move in gold here. I know we're talking about smaller moves as of the last year and prior to that, obviously. But do you anticipate these breakouts to be significant? I mean, you know, starting to really have some real excitement in the precious metals market. I've been watching Bitcoin. Yesterday we hit 8,000, and you know we're $200 higher today in Bitcoin, and I'm just curious, are we going to see that? Do you expect that to happen in gold, or is it just a different market, different animal?
It's a completely different animal. Been around for 6,000 years for one. And there's no counterparty risk if you got it in your pocket. And how the market's being affected, I would much rather see gold on a nice, steady, slow accumulation phase, which is what it's doing right now. It's accumulating a very strong base. Where we go after that 1380 is anyone's guess, because it's got just as much to do with fundamentals, which are stronger than ever, as it does with external events, black swans, geopolitical events, domestic issues because you got that paper market involved in it. When, the HFTs and the algorithms are reading the headlines, it sees one or two words and boom, it goes the other direction. Plus you got the manipulations going on in either direction and hedge funds playing in the game. And we've got the continuity, not the continuity, but the commitment of traders reports. It's just so lopsided right now. I've never actually seen it this lopsided for this long. We're in a standoff actually right now. And the commercials, I think, may, in the very few times, sometimes they get stuck on the wrong side. 99% of the time, they're not on the wrong side of the trade. When price is going up, they're layering on shorts. When the price is going down, they're layering longs. Now it's just kind of like stuck. What are the hedge funds are very long and the commercials right now are very short. How is that going to play out? It really depends on the big picture. Economics, geopolitics, black swans, and there's a lot of things to keep track of right now. So I really can't answer you with price, but at some point, something has to give. When? Hey, as long as they can print out money and get away with it, it'll continue. In Bitcoin, a completely different animal, but that's starting to come into the mix. Those regulations are going to come in. Now you're going to have paper contracts affecting the market. It's going to be centralized, data-based, et cetera, et cetera. That's another whole story. But yeah, gold could have its Bitcoin day, and it'll be a repo move.
I don't think I heard that term this whole interview until now. So, Steph, it was a pleasure having you on Crush the Street. Everyone, if you enjoyed this call and if you enjoy Trader Steph's work, we'll have a link in the description area for all of her articles. And, be sure to check back at crushthestreet.com on a regular basis to see her work. Steph, any closing thoughts you have before we say goodbye here?
Yeah, thanks for having me, Ken. It's always a pleasure. And everyone needs to become their own central bank.
Powerful words right there. Okay, Steph. Well, hey, you take care, and we'll talk to you next time.
All right, thanks, Ken.